Welcome, everyone. My name is Janet Forrest. I'm one of the adult program coordinators at the Nantucket Athenaeum. Thanks for coming tonight. We're starting a three-part series on financial health and financial issues, and tonight's topic is credit and mortgages. So I'm going to turn it over to Abby de Molina, and she will get it started.
Great. Thank you, everyone, for attending. My name, as Janet mentioned, my name is Abby de Molina. I work for a bank called Santander Bank, and I am also a full-time resident here on Nantucket. But I got involved with the Athenaeum in doing some of this work this summer. We did a bunch of different sessions, but through Santander and a different bank, a couple of other banks I worked at, Fidelity and Citizens. We've done different educational workshops for different focus groups. And so we wanted to provide just this, it's an overview. It's not really based on my bank job in that any of this is specific to where I work, but more we leverage tools that are available in the financial field to help educate people about their options. So as Janet mentioned in the communication, today's session is going to be on credit and mortgage, but we also have upcoming sessions talking about retirement, and we're going to talk a little bit about volatility because there's been a lot of market volatility lately, as I'm sure everyone's aware. And our last session is just going to talk more about investing basics, so not specific to retirement, whereas next week's session will be focused on retirement and different options and what different folks can do as they're reaching that time period in their lives. So as I mentioned, our first session is talking about credit and mortgage, and we're going to get started. So as an FYI, this curriculum is based on something that's called Money Smart, and it's developed with the FDIC, the Federal Deposit Insurance Corporation. So if anyone is interested and you want more, they have a couple of different worksheets. They have a lot of background. They have a workbook you can do. There's a lot of information out there. So I'm happy to provide the link if people are interested and you want to learn more. But this specific set of slides that I'm going to go through is heavily based on the FDIC, who they're the ones who insure up to $250,000 of bank deposits. So a really good consumer finance organization. And this curriculum is pretty good, especially because there are different tracks. So there's a track for young adults, there's a track for adults. So they also have pretty focused information if you want to hear more. So
I'm sure Abby will stop for questions, but if you have questions, you can put them in the chat and we'll get to them at some point.
Yes, feel free to interrupt if you have questions. Happy to answer them as they come up. So the couple of modules we're going to focus on today, as I said, it's really focused on credit and in mortgages and home decisions. So the modules, there's one on credit reports and scores, basics about borrowing, utilizing credit cards, and then the other two models are really the housing focused ones, which are about making housing decisions and buying a home. So starting talking about credit reports, I know sometimes this area can be super daunting because there's a lot of information, but it's also hard to know what you can do and not do. So I'm just going to start with the basics, and this might be a refresher for some, but it's also really helpful just to remind yourself of what's important with your credit and why it matters. So basically, your credit history can really affect all aspects of your life, whether it's getting a job, getting insurance, your housing, also any sort of credit cards, anything like that, a lot of services. But also, it's important to understand what your rights are and how to protect your credit history and also make sure it's accurate, because a lot of times there can be errors. It's not 100% foolproof. So it's always great practice just to make sure, even if nothing untoward is happening, that you're just monitoring and making sure that your information is accurate and correct, so that if you do need credit, you know, if you're applying for a loan, a job, anything, that the information there is 100% accurate. So what's listed in a credit report is obviously your identifying information, some of your debt, some of your bills, any of your public record information, and then also anytime you apply for credit or their inquiries. So a lot of times if you might be moving housing, they might do an inquiry. Obviously, if you get a car, something like that, and you finance it, those are the types of things that will show up as credit. And for credit reporting agency, it's important to know there's three. It's Equifax, Experian, and TransUnion, and that you can get your credit report from any of them, but they're not all exactly the same. They're pretty similar, but again, just important to remember they're not going to be 100% the same. So it's important just to make sure you monitor them and see that everything is as accurate as it can be for your background. So again, some of the places that use credit scores are, you know, banks, financial institutions, landlords, utility company, you know, for your water, sewer, electrical, etc. Some cell phone companies, some insurance companies, but it does depend on the state. I want to say if you're in the state of California, I don't know if they can use it. Some employers use it, and then of course some state agencies and different affiliated organizations will use it. And of course, as I mentioned, anytime you're applying for credit, if you're getting a car loan, if you're getting a personal loan, you're getting a credit card, they'll obviously also look at your credit score, which what it's based on, it's a number, it's based on the information in your credit reports, but what's important is it predicts how you pay your bills and debts as agreed. And then when it becomes really important is obviously if you have a higher score, then you'll get better rates because you have a lower risk to creditors. So that's why it really does matter to keep an eye on it and make sure that if there is anything in there, if you did happen to make a mistake, which it happens, everybody does, that you keep an eye on your credit report and at some point they do fall off. And what we've talked about before is if you do have some sort of adverse action on your credit report, they do fall off after 7 years. So I think you have to go back one, maybe. Yeah. So as I talked about a little bit, credit reports and scores can be used in what's called risk-based pricing, which is when lenders set interest rates and other terms based on the risk. So this is an example of like a credit card company might use it. The important thing to know about this is that if someone does use it in risk-based pricing, they have to notify you and let you know that they used your credit report. And if they did deny you or anything, they have to be explicit about it. But a lot of times what you'll notice is if someone does run your credit report, also at that time you do have the option to usually get a copy of that when they do have it. So two factors under this are what's called adverse action notices or risk-based pricing notices. So again, adverse action is just if they're going to deny you or that they're not going to give you the most favorable terms. So as I mentioned here, one of the things that you can do is there's something called opting out where you can opt out. I know a lot of people get, not as much anymore because of the mail, but everybody knows a lot of times you get the mail and it's those free credit card offers. You can opt out of receiving those pre-screened offers for credit or insurance. You can do it for either 5-year tranches or you can permanently do that. You still could get put on some other lists, but it's a good way if you get a lot of junk mail, or even it's not necessarily junk mail, but maybe you just something that might tempt you if a lot of people have gotten into credit card debt. Again, that does happen. If you're afraid that that will be something that is, you know, unnecessarily hard for you to avoid, then you can opt out, because one of the things is you can always opt out so you don't receive those offers, and then later you can opt back in. But one of the things you can't do is you can't not have a credit report, in that you can't say, I don't want anyone to measure my credit, because unfortunately that's not really optional. That being said, if you don't have a credit report or scores, you're what's called credit invisible. But what happens with that is usually it's definitely a burden or a hardship for you, because it'll be harder for you to obviously get credit or a loan. It can be difficult to rent an apartment if you don't have any credit history. It's also hard to get a favorable cell phone plan. Some jobs require credit history, depending on the industry. And then, of course, some places, if you don't have it, then they might require a large deposit. An example would be on utilities. So if you didn't have any credit, then you might have to pay some sort of upfront large lump sum. So these are some of the reasons why maintaining and having good credit, it's just to your benefit. And then obviously for your scores, there are ways to improve and manage your scores. And one of the basics is obviously just paying your bills on time and as you agreed. And as I said, though, again, things happen. There are ways that you can improve your score. Even if, something happened, you can, of course, pay your bills on time. This little table here is, or not a table, it's a pie chart, gives you the basics for the FICO model, which is one of the main credit scoring models, that they take into account these 5 different factors, which is new credit. So if you're applying for new credit cards, a new loan, something like that, that's 10% your credit mix, where it's good to have a diverse kinds of credit, and not just like 100% all of your credit is one thing, one loan or one credit card. The length of your credit history also is important, where I always remind people, even if you have a credit card or a bank account that you don't use a lot, but you've had it for a long time, it's good to keep that line of credit open, just because it shows longevity. I know personally, I have a credit card that I got a very long time ago before I went to college, but I have kept it because it's just good to have on my credit report. So even though I don't use it that much, it's just, again, it's one of those good things to have. The other two much bigger pieces are obviously your payment history, how often you pay on time, or if you haven't paid on time, that those things show up, and then the amount that you owe, because often what a lot of places will take into account is they'll see, even if you have a lot of credit, but you owe a lot, then that might work against you. And with credit scoring, kind of some of the basics, obviously, numbers based on what's in your reports. Generally, the higher number means you have better credit history. And again, as I said, it predicts the likelihood of payment. Some of the major factors are obviously how much you use your credit, and then whether or not you pay on time. And as I said, there are different producers of credit scores. So as I said, you're probably going to have multiple ones. There's the FICO, which we just talked about, which stands for the Fair Isaac Corporation. There's another one called Vantage Score, and there's some other less known ones, but FICO and Vantage Score are probably the two most well-known ones. So often you'll hear, again, in the jargon, your FICO score. It just means your credit score. So that being said, this little table talks about what's really good credit score. I don't have to go through it, but this is just a general tip for you. It's not the end-all be-all, but very helpful. Usually aiming to have anything over 700 is really good. But again, it depends. Everybody has different circumstances, so it can change. If you do happen to get turned down for credit, you do have the right to see the score that they used. And as I mentioned, one of the important things is just to make sure that you accurately reflect the information in your credit report. So you can obviously dispute, you can update it. So this next part is really important, just because a lot of people don't necessarily understand as much about this, that you have the right to get and review your score every 12 months to make sure it's accurate, and you have the right to free reports. what's tough about this is there are a lot of imposters, companies that will sell credit monitoring, these other things, and they'll make you think you have to pay because they'll give you a trial period. But the important thing to know is that you never have to pay. It's always free. So what I would tell people is you go to annualcreditreport.com directly, and you will get your free report every 12 months. You can get it from each of them. So just be wary. Again, a lot of places are very slick the way they market it. They tell you it's free, but then they come, but then you have to read the really fine print. So if you're not sure, again, just go to annualcreditreport.com and you'll definitely get the correct, accurate, and free credit report. Are there any questions? I know, again, that's pretty confusing. I know it's an area where a lot of people get tripped up because it's hard to know if the place they're saying it's free, but then it's not. Do you guys have any questions?
No.
All right. If you do, just let me know. So as I said, there are other reasons you can also have the right to your free credit report. If you receive public assistance, you're looking for a job, if you obviously are a victim of identity theft or fraud, and some state laws provide, oh, I think you went back one, Janet, sorry.
I'm sorry, hold on. There we go. And
Yeah.
we had something in, there we go. One more. Let's see if I can get it. Where's my mouse? There we go. Is that right?
Yeah.
Okay. And we just had something in the chat. We can get 3 reports annually, one from each of the 3 major companies.
Yeah.
So the 3 different, okay. So
Equifax, TransUnion, and I had it on the first page, but yeah, you can get one from each of them. So each year, every 12 months, you can get one from each of the 3. So if you go to annualcreditreport.com, it'll let you request from each one.
Do you have to do it all at once, or can you spread it out over the year?
That's a good question. I don't think you have to get them all at the same time, but I think, though, it is an important question of, I think you'd still have to wait 12 months between each one. So like if you went to TransUnion, let's say this month, you wouldn't be able to go back to TransUnion until November of next year. But I think it is interesting to know, yeah, but if you went to, say, Equifax in February, I think because they're all each separate, I think you can go to each one separately. You just would have to wait 12 months between them.
Right. Well, I just thinking like that way you could kind of almost monitor your credit throughout the 12 months if you do them, spread them out a little bit, so you could kind of get they're all similar, because I've done it. I did it all at once, but that way, you know, you could kind of keep track if there's something going on or whatever might be an option. I don't know.
Yeah, no, that's actually a great point. That is a really good tip, and you can do that. Also, what's showing up here is there are a couple of ways you can monitor as well. I know some credit card companies, different nonprofits, they'll also monitor it for you on a monthly basis. So for instance, you might have like a Chase credit card, and they might include your credit score as part of that, and then you can see every month. But to your point, it's not necessarily each agency every month, but it is a good way to keep an overview. So no matter what tool you use, it is a good idea to kind of keep an eye on it, so you're not necessarily waiting a whole year to look, because obviously we think about this time last year, it was very different than where we are today. So I think that is a really good tip. So as I show here, there are a couple of different places. As I mentioned, some credit card, you might want to check. If you have a credit card, check with your company. You can go to My FICO or Vantage Score, and of course the 3 agencies. But what I was saying a little earlier is there are some other situations you can get a free credit report if, you know, you're denied credit or apartment or employment, or, you know, you're having any of those issues. You also will qualify for it. And then what's in it are obviously your personal info, public records, any accounts assigned to you, any credit accounts, and any inquiries. So that being said, as I mentioned, they are not infallible. So there can be errors. Make sure to file a dispute. Make sure to keep records. Identify the errors. There are all sorts of them. There can be the identity ones. A lot of times this happens if you have a similar name to someone in your family, like if someone happens to be a junior, or there's same first and last name, but maybe a different initial. A lot of times it's not intentional, but people can get caught up with those kinds of really similarities of very common names. Like, I know if I think of my father, his name is Andrew. I have 2 cousins named Andrew. One of my nephews is named Andrew. My father's uncle was also named Andrew, and they all had the same last name. So in that sense, you'd have to make sure to keep an eye on it, because some things from their credit might just pop up on yours just because of the name similarity. There can either be just incorrect reporting, there's data management, balance errors, or sometimes the information is just old and outdated. So again, just good to keep an eye on. As I mentioned a little earlier, any of the negative information usually drops off after 7 years, but the only thing that doesn't is there's no time limits for negative info. If someone's applying for a job with 75,000 or more, or looking for really anything 150,000 or more worth of credit. So that would be usually with like a mortgage or life insurance, anything like that. So that being said, when I talk about the 7 years, what we wanted to know is it's also 7 years, but from 6 months after you stopped paying. So this example says, like in August 2018, you're 30 days late. By November 2018, you're 128 days late. So the 180 days, the 6 months, doesn't really start until January 2019. So then 7 years from then, which would be January 2026, would be when that would fall off. So things fall off after 7 years, but really it's 7.5 years if you do that math. One of the important things that's important to note, I think, especially here, is usually medical debt isn't on credit reports until it's unpaid for the 6 months, which usually helps people resolve billing, make payment arrangements. I know anyone who's probably had to deal with any sort of medical debt, it's very complicated and it's slow. So that is one thing that's helpful to know. And when you are disputing, you can do it online, you can do it by mail, you can, there's a bunch of information you can include in dispute letters. And then after you file the dispute, of course, keep track of all of your paperwork. You should get a letter back, and you can request to be notified of corrections, and that if they're sending it to a specific organization. So like an example would be if you were getting a car and then you notice something's wrong, you could have them send it to like the company that would be financing the car loan. But if anyone needed help with this, we do have templates for any of these dispute letters. So if you do need any of that, just let us know. It is helpful to have, is just to make sure that that you have a way to dispute it, because that's your right. And then that being said, you might have things on your credit that aren't errors, but it just might be, things that happened. As I said, things happen, and life gets in the way. So just make sure, even if something has happened, that you repair and improve your credit. Reviewing anything, disputing it. Try to use as little credit as you have to. As I mentioned, keeping old accounts open, applying only if you need it. You can negotiate terms if you want, and you can ask for something called a goodwill deletion if if something just keeps showing up but it's not anything you're using, you can get it deleted off. And then there are also a bunch of tools that you can use to build credit, something such as a secured credit card, a credit building loan, becoming an authorized user or a cosigner, and then applying for a credit card at a store or gas station. So an example of what that means is, if you think of a store like Target, you can get a card with them, but it's linked to your existing bank account. So it's not like you're getting another credit card. But that being said, it is a way to build credit. And then obviously, if you have tons of money lying around, you can make a large down payment on a loan for the balance. And that was also something that will build up your credit. And also on your own, you can build an alternative credit history by tracking bills that you pay on time. So there might be other things that might not be on your report. So, rent, childcare, your cell phone, some of your utility bills, internet, insurance, if you have loans, different things like that. So if you are working on repairing or building your credit, if you're tracking this stuff, if that's also stuff that you can use to provide proof of your good history too. So as I said, in order to maintain a lot of the same things, make sure you pay everything on time, pay things down as you can. Don't apply for too much credit. One of the things is pay your taxes and child support, because one of the first people who will report you if you're not paying is the government, and they're pretty good at that. So make sure you pay those ones so that it doesn't go in your credit report. And again, probably just as a good general practice is keep good records, whether they're electronic or paper or both. Keeping good records is also good. Again, just good tool, good practice to have. So if you ever do need to dispute anything, or you have to provide some sort of backup, if you're already keeping good records, then your work is kind of already done for you. But that being said, that can be tough. So there are ways you can get help. I mentioned I work for a bank. You could go into your bank and they can help you like track your credit, keep good financial records. A lot of this is a service that any bank will provide you for free. You don't have to pay. You can also sometimes go with a nonprofit consumer credit counseling service, or there are a bunch of different housing ones as well. But it's just important to know you have a lot of options if you do need help, if you need like someone to help you set up a plan, if you wanted to repair your credit or pay your bills on time. Again, you can go through any of these places and they will be able to help you. That being said, use caution with these ones, which are credit repair and debt consolidation companies. They'll often offer to fix things for you, but it will cost you money. And to my earlier point, there are a lot of organizations that will do it for free. So I would not necessarily recommend that as a first option to use these companies, because they're giving you a service that they're giving you a service you have to pay for that you could in reality get for free from a different organization. So yeah, this is part of the scam report. Beware of companies that promise to erase or remove everything. They say it's fast and easy. anyone obviously offering to create you a new identity or want you to pay up front or won't tell you about your rights. Those are not reputable organizations. But again, if you're not sure, what's always a good tool is you can go to the state to confirm if that organization is in good standing and that they are reputable. You can find that out through the state. You can obviously ask us, we can help you, but just be careful with that, because anyone who should be helping you should be doing it not for a fee. So that being said, protecting your credit history is just some of these things. If there's a fraud alert, if someone's active duty military, if there's extended fraud, and then if your credit is frozen or locked. So that being said, now that you understand a lot about your credit, we're going to talk a little bit about borrowing, which is like what to do once you understand what your credit is. And what it means is obviously someone provides you money and you have to pay it back with interest. So credit's your ability to borrow money, and debt is the money you owe a person or a business. There are a lot of different ways you can get money. There are different kinds of loans. We're going to talk through some of these. There are installment loans, revolving loans, rent-to-own services, and then buying things on layaway. These are a couple of different tools. The difference between the two types of loans is installment loans, you pay a certain amount every month, every year, something like that. Usually that's when we're talking about mortgages, your car, student loans, but then revolving loans are usually things that are kind of lines of credit. So that's usually something that is a credit card and home equity. And so the real difference is an installment is usually you pay the same amount every time, whereas revolving, it can shift, it can move a bunch of different ways. And then rent to own is, you keep paying something until once you make all the payments, then you're able to buy it. And then buying layaway is similar in that you put a deposit and then you pay over time, and it's held until you've paid. So both of those two options, usually there's a consequence if you miss a payment. So there are also a couple of other kinds of loans, secured and unsecured loans. Something is secured where it has collateral. Examples, obviously your house or car, and obviously you lose the collateral if you don't pay. Unsecured is there's no collateral, but because something's unsecured, it's known as more risky. So usually they have higher rates because there's no collateral. So if you don't pay, they don't get the car, the house, or whatever in return. So when borrowing money, the general rule is you're going to pay more than you borrow, because you're going to pay the principal, which is the amount you borrow, and then the interest, which is the amount, whatever the organization is, what they charge you to use the money you're borrowing from them. And then there's also usually some sort of fees. If you're able, so when we talk about prepayment, that's early repayment of a loan. Usually it reduces interest and pays off the loan if you repay the entire amount, or if you do part of the loan. Again, it usually reduces the interest, but it also usually gives you an earlier payoff date. So an example of this might be, for instance, student loans, where if you repay part of it, then it'll advance when the payoff is due. It's important to know if you are going to prepay or not, that you look into the fine print, where sometimes places do penalize you for prepaying, some don't. So if you're going to use that option, just explore before you do it. So when talking about lending, there's a lot of tools from the government to help make sure you have your rights and you understand what you're getting. So there's something called the Truth in Lending Act, which is a written disclosure, and what they require you to show, we have this little box here giving an example, requires you to show relatively easy to understand the terms of the loan and what you're getting. So in this example here, it's saying the annual percentage rate explains to you what that is, the cost of your credit as a yearly rate, what it is. In this example, it's 12%. The finance charge, which is dollar amount the credit will cost you, is $600 because that is literally the 12% multiplied times the amount you're financing. And the amount financed, you can see, is the amount of credit you're getting. That's the principal, $5,000. And then the total of payments is those two put together. So Truth in Lending requires that you're able to get that information, and it's laid out pretty straightforward. Where it's really helpful is, let's say you are thinking of buying a new car, you can get these different TILA, as they call them, TILA disclosures, and you can compare them. So what you could do is you could use it to compare a couple of different offers. So you could say, oh, if I finance $4,500 at 10%, it's this, but maybe if I finance a different amount, but the percentage is different. And so you can really use these tables to figure out what's going to work best for you. And since they're pretty uniform, it's a good way for you to compare. So if you are ever borrowing money and you are shopping around, you have the right to ask for the TILA disclosure before you sign up for anything. And by law, they do have to provide it to you. So when preparing to apply for a loan, what you should do is obviously consider what the lender will look for when they're making the decision. Obviously, one of the things that we just talked about is your credit, and they call this the 5 C's: your credit, your capacity, your capital, your collateral, and the conditions. So those are the major things that are any organization will look for when they're going to be lending you money. And so this is a little more details about that. For credit, your character is just obviously if you pay bills, do you pay them on time, how much credit you have, if you've ever had anything against you. For capacities, then obviously your ability to make payments as you need, how long you've had your job, how much money you make, a lot of your current state. Capital is the value of your assets and your net worth, so how much you have financially. Collateral is, again, for secured loans, is anything you would have that you could use against that loan, such as the house or your money. And then for co-borrowing or co-signing, co-borrowing is you take out a loan with someone else. What's risky about this is obviously you have to repay it even if the people you borrow the loan with do not. So the difference between this and co-signing is the loan proceeds go to the borrower, not the co-signer. So the co-signer promises to pay the debt if the borrower does not. So what's different is, like, I'll use an example. If Janet and I co-borrowed together, we would say, okay, we're going to borrow $10,000. We would get the money together, and she might get $5,000 and I would get $5,000. And then maybe Janet says, I'm not going to pay my $5,000 back. I, as the co-borrower, would then have to pay back her $5,000 and my $5,000. With co-signing, Janet and I apply for a loan, and I co-sign. I say, okay, I'm going to pay back. Janet will get the $10,000. I don't get any of the money, but I say that I trust Janet and I think she's going to pay it back. So it's just slightly different situations, but just make sure that you know if you are in a situation where you are co-signing or co-borrowing, that in either case, you will be expected to pay the money back. So just be aware of that. But that being said, it is also a tool you can use when trying to build credit, because if you co-sign on a loan and it is paid back on time in full, then it will obviously help you on your credit too. So one of these situations that we might talk a little bit about next week as well is is borrowing money when someone helps you manage the money. This is really important, where you have to understand, you have to make sure that the person who's helping you, this is a financial advisor, financial planner, that they're acting in your best interest, that they're managing everything carefully, and that the money is being kept separated. Again, good record keeping is important here, and that you're really included and you have a good understanding of what's happening. So if you are doing that, just make sure that you discuss all the specifics, why you would need to borrow, do you have enough to pay it, how are you going to pay it, what will it affect your income, what are the best options. And if you do obviously decide to borrow money, you can get help doing any of those things, considering the terms, completing the application. The lender will decide obviously how you are as risk. And if someone's helping you, their credit does not come into account. But again, most importantly is make sure you're paying on time and keeping good records. And next, one of our tools also with credit cards is, with credit, is talking about credit cards, how they work. As I mentioned a little earlier, they're a revolving line of credit. It's a good way to buy things. It's buy now, pay later. A good practice you can do is, if you put money on your credit card, pay it off each month. And in that way, it's building your credit. They're obviously an important tool. They can help show you're credit worthy, can help for emergencies. Obviously, they're very convenient. And then in terms of rights, you obviously have the right to dispute erroneous charges and or other charges that aren't delivered the way it was agreed. Some cards that aren't credit cards, that just make sure people understand, charge cards or prepaid cards, stored value cards. Also, your debit card is not a credit card, because any debit card that's linked to a bank account where the money comes out straight out of the account, that is different from a credit card, because obviously there's no credit involved. It takes the money that you have. And again, we just talked a little bit about truth in lending. Similar to, or as part of any loan, you also have to get the truth in lending disclosures on any credit cards. And they have a lot of the important information about rates and fees. So we talked about the annual percentage rate, APR, that's the cost of credit expressed as a yearly rate. The penalty APR is important to know, the increased rate if you don't pay a bill on time, with and then your interest rate if it's fixed or variable. Often with credit cards, they have these low introductory APRs, which in the example, it's like 0% for 15 months, but then it might go variable to 15.49 to 25.49. Those are pretty high. So again, it's just important to know what your rates are. And some other important terms, knowing what your credit limit, the maximum amount of credit you can use. Each creditor they have their own standards. They might look at what your income is, your debt, what's in your credit history. There is some bit of a grace period when your statement is issued and when your payment due. Like usually you don't get your statement tomorrow and your payment is due on Saturday. You have some time. But that being said, creditors don't have to give a grace period. So that is, again, just something to keep track of. Make sure you keep in mind. Also, understanding how your balance is computed. This is really important to know. There's a couple of different ways. One way is your average daily balance. However it is done, your credit card company will have an agreement with you, and it'll tell you what they use. And so it just talks about the interest. So an example would be if you borrowed $1,000 and then you paid it off immediately, your interest would be minimal if they're using the average daily balance, because if you only had that balance for a couple days. But if it's a different method, like if it was monthly, then it wouldn't matter. So you would have higher interest. But again, however it's done with your credit card, it will be in the agreement. Also, one of the tools that are great about credit cards is they do have a lot of rewards. rebates, points, airline miles. Important to know what you're looking for and how to maintain. Also, to make sure you avoid the trap of sometimes they have such great rewards, but you're overspending just to meet it. Where an example is, you might get a credit card and they say, if you spend $10,000 in, 6 months, you can get 100,000 points. But if you normally only spend $2,000 over that time, if you're going to have to overspend significantly just to get those points, then it's not worth it. So it's just important to know if you're going to be if it's not going to work within your current spending, your budgeting, then it's probably not worth it. But also just look around. There's a lot of great tools such as NerdWallet where you can compare different credit cards. They can give you, again, lots of great information to figure out, if you're looking for airline miles, which cards are the best, and, how are the rates. Again, there's a lot of really good tools out there, and we can provide you the links that you can use to just compare. For instance, with credit cards, that's a great one, is NerdWallet. So. There are other important features with credit cards, your customer service. Sometimes you get extended warranty. Sometimes you get travel insurance. A lot of cards provide, if you travel, the additional car insurance so that you don't get it from a rental company. They also provide, as I talked about, some provide credit monitoring, payment protection. So those are some additional kind of benefits of any card. And then we talked a little bit about unsecured and secured loans. There's also unsecured and secured credit cards. So obviously an unsecured credit card doesn't require collateral, but secured credit cards might require collateral, such as you keep money in a certain account. It might link to your card's credit limit. These, again, are usually helpful tools if you have to rebuild your credit, where you might have a card that is a secured card for $1,000 and you have to link it to an account with $1,000, then you use that to pay it off. They're obviously easier to qualify for than unsecured cards, and they usually have lower limits. But again, they can help you build your credit history. That being said, when you're going to apply, there's a lot of different places you can apply. You can go to financial institutions, banks, such as where I work. Tons of banks have credit cards. As I said, there are card comparison sites such as NerdWallet. You obviously can get stuff in the mail. I know we talked a little bit about earlier. If you're tired of getting those offers, which I think a lot of people get, you can opt out. You can call to opt out, or you can use this link to opt out so that you stop getting credit card offers. But again, some of these key terms are the applicant, the person who's actually applying for the card, the creditor is who's going to give you the card. If it's individual credit, it's just for yourself, or joint credit might be if you're applying as, a couple, family, or if you add somebody as an authorized user. Those are a couple of the different terms, whereas joint credit means you're applying together and your credit will be considered. Whereas if you apply as an individual, it would be based on your credit, and then the authorized user, their credit would not be taken into account when applying. And again, just make sure you manage everything. There's a lot of information on your credit card statement, talks about credit counseling, tells you about your interest rate, any of your transactions, any of your charges, fees, all of those, and then it explains your interest charge. So again, this is a lot of information, but sometimes it's hard to understand. If you ever have any questions, always talk to a financial professional. As I mentioned, you could go to a bank and talk with your local banker. They can help you understand what's in a credit card statement, because sometimes they are really confusing. And again, they're not going to charge you for that service. It's part of their job. That being said, can't say this enough, managing your credit card, keep good records. Again, check for any mistakes. Mistakes do happen. Sometimes, people, they confuse payments, things like that. They can be, there can be human error, or especially if you use your card at a place where it might be done in a more manual way, it might be going on the wrong card. So just make sure you keep an eye on your statement and you track the spending and make sure that it matches up. And then check for those mistakes, pay on time, make sure you pay at the very least the minimum, but then also understand how your payment strategies work. But in general, try to limit what you owe so that you're not always at your credit limit. When you are paying, if you pay the minimum balance, usually it'll be applied to the part that has the lowest interest rate, not the highest. But if you pay over your minimum payment, that will go towards the highest. So an example is if you're talking about a card that has one of those introductory fees, what that means is, let's say you, you bought something for $1,000, but it was 6 months ago, and now your introductory fee is over. If it says, okay, your minimum payment is $75, it's going to go to the part that maybe you bought something last month for $200. It's going to go towards that has the no interest, even though you have $1,000 that you owe, and now it's going to be generating interest. That part won't be paid with the minimum balance. You'll still owe that, and then it'll continue to generate interest. Whereas if you paid, your minimum was $75 and you paid $175, at least that $100 would go towards paying off that $1,000. So again, just make sure to kind of understand of why it's important to, if you can pay more than the minimum, that you do that, because then it just makes it easier for you to pay off in time. And so here's an example of a couple of things. So it's saying if you have a balance of $2,500 and the APR is 18%, if you only pay the minimum payment, it takes you 23 years to pay off, but that you have to pay an astronomical $5,400 in interest. So you, for only $2,500, you have to pay almost $8,000. Whereas if you just paid a little bit more over your minimum payment, $2,500, you pay just a little over $40 a month, you can pay it off in 3 years, and you're only paying $750 in interest. So again, this is just helpful so you understand that even though it seems like it's not a lot, even if it's just you can only afford to pay $10 or $15 or $20 more, it still will help you in the long run because it'll take you a lot less time to pay that off. So again, just something to think about. So that being said, that's the end of the credit section. Does anybody have any questions? All right.
Oh,
Just wanted to make sure.
I have a couple of questions.
Sure.
What was the credit building loan? Like what's an example of a credit building loan?
So when we talked about something that's a secured loan where you have collateral against it, that's something that can help build your credit because you already have the collateral. So it just helps you where they know that you have the risk, so you're going to pay it off. But that being said, what's a practical example would be either a mortgage or a car loan, because those are both two types of collateral, but those are good credit building loans because they're obviously secured in that they loan you the money for the car, but if you just stopped paying, eventually they could get the car. Same thing with the house.
Okay. And you talked about an alternative credit history, and say you gathered that information, who would you send it to build your credit? Like in what scenario would you, if you had all those records?
So that's a great question. It would really depend on who would, if someone's looking at your credit, but like an example could be, let's say you were going to rent a place and they were going to run your credit, and they might say like your credit's not great or they don't know, that would be the example of where you would say, okay, well, actually, I have this alternative credit history, and this proves that I'm going to pay on time. So that would be who you would be presenting your alternative credit history to. So if someone is looking to give you, or they're looking to give you credit, that would be. So it does really depend, though, if it's like not necessarily the credit agencies, but it's more if someone else, you're trying to get credit from them, and you can say, hey, well, I do have this proof of my payment.
So can you think of a less expensive secured loan? That it's pretty expensive to get a mortgage or get a car loan just to build your credit.
Right. No, that's fair. But actually, a good way to build your credit, though, that is less than that could be doing, as we talked about, the secured credit card or a secured account. Whereas like you could get a secured credit card probably for like $500, $1,000. So you could get it for a much smaller amount. And that's still a way that you could build your credit. So it doesn't have to be, those are just the bigger ones because they're more common, but you could get a secured card, and that would similarly be, and what you would also do is if you're using a secured card, you could use it just if you're trying to build your credit is like pay monthly your cell phone bill or your electrical bill, something that like you're going to pay anyway, and it could be a much smaller amount.
Oh, sorry.
Here, I'm going to mute you. There you go.
So, does that make sense?
It does. And yeah, well, and in turn it could build history. Like I think I gave this example last time when this was years and years ago, but my parents, when they were first trying to buy a house, my dad worked at Sears, and it must have been a secure credit card. So he bought like stereo speakers that would have been like a few $100s or something. And he took it out as a loan, but he set it up so that it would get paid back monthly over a year or something. And it was just enough for them to build up a little credit. But then having that alternative credit, it could get you an apartment that then becomes part of your official credit history. And then you can leapfrog from there. So yeah, that makes sense.
Right. Yeah, and the thing that that's a good example that Janet said is and I think the thing is what's also important to know is obviously like a secured, if you did something small like that, like from a store or something, they're also usually easier to get as opposed to, getting just like a random credit card that you want with like $10,000 worth of credit, which is a lot. That might be a lot harder to get than say getting a $250 credit line from, in this example, like Sears. So there are definitely a lot of different options you can use. But if you did want a secured credit card, one of the places you could start is if you do have an account with a local bank, you could talk to them to see if they have a secured credit card as an option, and then see what they would have available. I hope that makes sense. All right. If there are more questions, again, please feel free. This is meant to be interactive, but we're just going to talk a little bit about housing. So this is talking about options with housing. Obviously, there's renting and buying. Renting can be a room, apartment, house. There can be private, subsidized housing, public housing, and then buying could be, again, a house, a modular home, a townhouse, a condo, mobile home, or a co-op. And I think knowing what you can afford is probably harder than you think, but what it would be is an affordable payment is one you can reliably make each month. And that being said, really the only entity that can decide what's affordable is you, not landlords or mortgage lenders. Of course, they'd like to, but it's really what you're comfortable with. But I have this little graphic over here. There's a lot of different things to think about when you're thinking about housing, of your age, condition, or age and condition of the place, amenities, the location, the neighborhood, the improvement of, you know, if you get a house and then like it's going to need a brand new roof, that's something that's really expensive, interest rates, the market, all of those things are just important to keep in mind when thinking about it. I know we mentioned a little bit earlier, if you are looking for a home or a mortgage or even refinancing, this is a really good time right now, only because interest rates are so low. So you could get a mortgage with a lower than normal rate. So that being said, we talked about what you can afford. There are a lot of different options. These are some of the most common ones. One is, method one is usually helpful if you're looking for house, like a house or like a big lump sum, but not as helpful if you're looking for a monthly payment. So usually you take your annual gross income times 3 to estimate your home purchase price. So again, that's usually when you're looking to buy. Method 2 is much more helpful if you're looking to rent, and it helps you figure out what your housing costs would be for the month, but it should include not only your rent, also your insurance and utilities, maintenance and repair. So if you're doing that, again, make sure that you're realizing all of those pieces are part of it. So that's taking your monthly income and then taking 30% of that. Usually gives you an estimate of all of your housing costs. But again, make sure that includes all those pieces and not just your rent. And then for method 3 is usually when you have a budget or, you know, a spending and saving plan. You take your total income, you subtract out all your expenses that aren't related to housing, and then that'll give you your housing cost. So in that example, if your net income for the month is $2,000 and all of your non-housing expenses is $500, then what's left for housing is $1,500. So if you do decide to rent, what's next? One of the important things is really making sure that you protect yourself as a renter. So getting really good understanding of your rental agreement or lease, making sure you have insurance, and then knowing your rights. And so obviously one of the main steps is figuring out where you want to be, how safe it is, public transportation, access to what's important to you, work, childcare, etc. If there's schools, parks, if someone has a disability, make sure that it's accessible for you, and then anything else. And then once you figure out where, then you can figure out what kind of place you want, and then you can afford. So an example could be like you figure out, okay, I want to live close to town. I don't necessarily need a whole place. Maybe I just need a room. And then you would figure out what you can afford. So this is where your credit obviously comes in helpful. Is again, your landlord will probably look at your credit report or your credit scores. But this is the example where they might look at it, but if you didn't happen to have great credit, this could be a venue where you could say, oh, well, I have an alternative credit report, and you could provide your alternative, like, you know, reporting that you have. And if you have low credit scores or a credit report with negative info, make sure that just to know if that happens, you still might be able to find a place, obviously, but you might have to pay a bigger deposit. You might have to get someone to co-sign. You might have to find roommates, or you might have to spend more time looking, just because some people might pass because you don't have great credit. When you're doing that, just make sure you research. A lot of this is doing it yourself. Like if you do it yourself, look on, you know, you can look on the internet, obviously. You can look, I know here in Nantucket, in the paper, there's usually more information. If you use an agent, they might have more local resources, but it also will cost you something. So also make sure you get your first and last month in any deposits, security deposit, any other fees, and if you have renter's insurance. Important note of why you need renter's insurance is if anything happens to the property, and then if there are any replacement costs, things like that, it provides financial protection. A lot of times if you're a renter, it's helpful where, you know, you might not have a ton of stuff, but you'll probably have a couple of things that are worth something. You might have a computer, you might have things like that. So if you do have those things, again, and you do have renter's insurance, just make sure that they're covered under that. There's a lot of different options out there. You can talk to a local insurance agency, or online, there's a lot of different kinds of renter's insurance. So it depends on how much it'll cost, but those things will be available. And again, the last thing is make sure you understand your lease or rental agreement. And I just talked about the renter insurance. And then understanding your rights. This is based on, obviously, the Fair Housing Act prohibits discrimination based on these items: your race, color, origin, religion, sex, disability, if you have children. And the housing has to meet health and safety codes. Those are important because if the housing doesn't and you rent and something happens, then you would maybe not be able to be fully reimbursed because it wasn't a legal rental. So what's next? You can request, if you have disability, you can request what's called reasonable modifications. Some of these might be, you know, the doorway, widening a doorway, lowering cabinets, things like that. The housing provider has to make the accommodations. And here's an example of saying like reserve parking near an entrance. Those are all things that are available to you as somebody who has a disability. So it's, again, important just to understand your rights as a renter. And then, of course, make sure you get help. There's the Federal Housing and Urban Development Organization, HUD. There's also a local housing authority. There are some HUD-approved housing counseling agencies in Massachusetts. I think the state agency is called CHAPA. There's legal aid. You can talk to an attorney, but any of those organizations would be able to help you just to make sure, again, maybe you just want to understand what your rights are, even as a renter. So that being said, the last thing is we're going to talk about is if you're going to be buying a house, what this all entails. So obviously buying a home is a process, making sure, again, you know what you can afford, and also, you know, what you're looking for. So the steps for obviously buying a home is getting ready, figuring out how you want to finance it, finding the house, buying the house, and then maintaining the house. But one of the reasons, obviously, a lot of people will throw this around for why you want to buy a house is you want to build equity. And what that is the house's value minus what you owe. So the longer you pay your mortgage, the amount of equity obviously goes up, assuming your house's market value either stays the same or also goes up. And as I said, this is an important thing. A lot of people will bring up this concept, you want to build equity, and what obviously long-term, if you buy a house for a certain amount and you pay off the mortgage, but the value ends up far exceeding that mortgage, then you've built equity without having to pay for it, which is obviously great. So again, the only one who can decide how much you can afford is yourself. But that being said, some of the tools that you use are of your spending and saving plan, of understanding what your expenses are, understanding what your income is, and then seeing if there's any leeway to decrease or eliminate your expenses, because as I mentioned in the previous slide, your net monthly income minus your non-housing expenses gives you how much is left to pay for housing. And then with your mortgage, you have to pay, obviously, the amount you borrowed, there's some interest. There are also going to be real estate taxes, and then there's your insurance for your homeowner. Not to mention other housing costs will be like ongoing, will be your utilities, things like that. Whereas sometimes if you're renting, that might all be included in your rent, but obviously if you own the home, everything is separate. So just something important to keep in mind. Another important concept to understand is your debt to income, which is how much you pay in debt divided by your income payment. So this might be, your monthly debt might be a credit card, your car loan, and if you get your mortgage, those would all be pieces of it divided by what your monthly gross income is. And as I said, usually for your housing piece, you want it to be 30% or less. Yeah, because obviously the higher your debt to income ratio, the less money you have to cover your housing expenses. So again, financing a home purchase, make sure you know the loan. As I talked about, these concepts are in your truth in lending disclosure, the mortgage, the amount it would be, the principal, the cost, and then your annual percentage rate. So your down payment is a portion of your home's price, which you pay in cash. In this example, which is not incredibly realistic given we live in Nantucket, a $160,000 home with an $8,000 down payment means you have to borrow $152,000. The $8,000 is a 5% down payment. Obviously, the higher the down payment, the less money you have to borrow. One of the things that is important to know is there are some programs in the state and in town where different types of loans where you might not be required to make a down payment, or the down payment might be low. So when looking for financing, it's just something to keep in mind. And when talking about loans, this is something interesting to know. Depending on the type of housing, the loan will be called something different. So if you have manufactured housing, such as a mobile home on rented land or somewhere it's not permanent, it's called a personal or chattel loan. If you have a unit in a co-op, it's a co-op loan or a co-op share loan. And then obviously if it's a house, condo, or townhouse, it's called a mortgage. So another important thing to know is there's private mortgage insurance. It's usually required if your down payment's less than 20%. It, again, lowers the risk to the lender, but it makes your monthly payment higher because you have to pay that additional cost. The two types of mortgage, that major mortgage types, are fixed rate and adjustable rate. Fixed rate is the interest rate doesn't change. You pay the same amount every month. It's a good choice if we're in the environment where we are now. Interest rates are really low and you plan to keep the mortgage for a long time. What might be helpful is, as an alternative, is an adjustable rate mortgage, which the interest rate might start really low and then adjust over time. So if it's something, you know, maybe you're buying a condo, but you think you're only going to have it for 5 years, there are a lot of adjustable rate mortgages that are only for 5 or 7 years. And so if you don't plan on having the property for a really long time, an adjustable rate mortgage might be helpful where you can you can pay the lower rate upfront, and then you know you're going to get out of it before the rate really increases. And this is also a good option if for whatever reason you can't refinance with a lower rate, but you want to pay less. This is an option you can do. When talking about mortgage, again, some of the important things to note are the loan amount, the type of interest rate, as we just talked about, the term of how long it is, and then any upfront costs you have to pay at closing. And so there are two ways. If you're closing, paying for tax and insurance, is you pay them part of your monthly mortgage payment, and you pay them out of something called an escrow account. And usually if you're mortgage, getting a mortgage from somewhere, they usually require you to do that. You can pay them directly, but that's usually if you're not borrowing any money. So this scenario where you would pay them directly, the taxes and insurance, that's usually less common. So some other important terms to know. Oh, go forward. Oh, it's going back. Yeah, here we go.
Sorry, is that right?
Yeah, that's right. So these are some other important terms to know. Rate lock, it just means that you choose a rate and it stays like that for a certain amount of time. The period could be, up to 60 days. But the reason why this is important is sometimes rates change daily. Also, it's important to know, usually there is some anticipation from the Federal Reserve if we think rates are going to change, if they're going to cut rates or increase rates. So if you happen to be thinking about getting a mortgage at this time, you do want to lock it in, because if that does happen and like rates go up, even if rates go up, but you had a rate lock before the Federal Reserve made that decision, then you can still keep your lower rate. So that's why it's a good tool to have. If you see a really good rate, lock it in, and then obviously you can change it if rates were to go down further, but it's also helpful if it's kind of to protect you from it being higher. There's something called a balloon payment, which is like a one-time payment at the end of the loan that is usually bigger. So an example of this could be, your normal payment is $500 a month, but then at the end of the loan, you have to pay $1,500. That would be an example of a balloon payment. For a conventional mortgage, usually what you need is obviously a good credit history, a regular income, what we talked about, the debt to income ratio that is within good limits, and then a down payment. And jumbo loans, which are bigger mortgages, they're usually above a certain amount of money. A lot of places might consider them above $500,000, might be above $750,000. They're for normally relatively expensive homes or in a high cost area, which unfortunately for us is where we live. A second mortgage is usually if you might have a mortgage already on your house that you've paid off, you can get another one, and it provides more financing beyond the first one. So some of the loan types, there are government guaranteed loans. These are the ones that it might depend if they might have certain kinds of income requirements, things like that. You can get a federal housing loan, FHA. There's agriculture loans if it's certain type of land, the Veterans Affairs if you or in the military, or even if it's just from the Housing and Urban Development Group. These loans, generally, if they're federal loans, they'll have lower rates. There's also other types of assistance. As I mentioned, there's down payment assistance, closing cost assistance. There are a lot of programs for first-time home buyers. Sometimes specific professions have programs. And then, again, there might be other programs from the State Housing Finance Agency, which I said for Massachusetts called CHAPA. So always worth checking. Their website should be chapa.org, but I'll have Janet send it out afterward if anyone's interested. Might be good just to check out, see if they have anything. They might not, but worth checking. So with mortgages, how they work, the amount of the loan, obviously the interest rate, what kind of rate, and the term and the amortization schedule. So when talking about different terms, obviously if the term is longer versus shorter, then the payment is usually lower, but it takes you longer to pay it off just because it's over a longer time period. And usually you end up paying more interest. But if you want to have the loan paid off, then having a shorter term might be what's for you. For amortization, the amount you paid each month is amortized, which means that it is spread out over time. So if you have an amortization schedule, it shows you how much money each payment goes towards the principal and how much goes towards the interest. And so you can see over time, you usually end up paying the principal off first. And another term that's really commonly used is pre-qualification, which is usually an estimate of how much money you'll be able to borrow. It's not an official approval, but sometimes if you're looking for certain type of housing, they might tell you, oh, you need a pre-qualification letter from a certain lender, and it might be a bank, somewhere like that. And it's usually to say, you know, if we were to lend you money, we think we would lend you a certain amount.
I have a quick question. Is
Yeah.
there a specific amount that a bank won't lend you for a mortgage? Like, because say the house is like $30,000 and will they like say, well, I don't really want to do a mortgage on that because it's too low? Or will they do a mortgage on any amount?
It really depends on the organization. I don't think most places wouldn't say no to the amount. They might say no to the person they're lending to. If like you weren't a trustworthy borrower, they might be more likely to say no. But usually it's not based, like they wouldn't say, oh, we're only going to lend you $100,000, because I think for a bank, if they know you are a good borrower and you're going to pay back, it's less about the amount and more just that they know they're going to get the money back. But that being said, if that were to happen, because they can't guarantee it, that's where, especially with mortgages, there's so many different organizations. So even if you like went to a bank and they weren't lending you what you want, then you can again explore online. You can explore the federal loans. So sometimes people might find it's easier for them to say, get a federal loan as opposed to from a private organization. So there is usually some sort of trade-off from that. But again, it's not usually based on the amount. It's more about how your credit worthiness is as a borrower.
Okay.
I have two questions. One is
Sure.
when you said there are programs for first-time homebuyers, I found out
Mhm.
something recently that I want to verify is true. You can actually have owned a house before, but if you haven't owned a house in the last 3 years, then you're considered a new home buyer again.
So I don't know if it's
Maybe each state is
necessarily,
different.
well, no, yeah, it might not necessarily be 3 years, but yes, in general, that you could have owned a property before, but it might have been over, past the certain amount of time that they might be willing to consider you
Yeah,
the first time home.
Yeah, but it's a big, I think at least for me, I didn't know. So I could have been qualified as a first time home buyer and gotten a better deal, but I didn't know. And the other thing I was wondering is in this slide here, it says, that you want to try to get pre-approval from more than one lender. Well,
Mhm.
if you do that though, and all three of those lenders check your credit, then are you gonna get demerits on your credit rating?
That's a good question. And no, because a lot of times if they're just doing a pre-approval or a pre-qualification and they're not actually offering you the mortgage, it's not what they call is like soft and hard searches on your credit. That isn't necessarily like they are extending you the credit for sure, because you're not going through the whole process. So a lot of times for something like that, you wouldn't have them like hit your credit so you're actually doing the mortgage.
Okay, so you just have to make sure they're doing a soft. Yeah, okay.
Yeah, exactly. I think you just have to be clear of like, hey, I'm looking for pre-approval for a mortgage, and you get a couple of options, but not that they're like, okay, I'm definitely getting an mortgage and like doing the full application, because that's where they would do the search on your credit, like the hard, what's called is like a hard search.
Thank you.
Yeah, no, any other questions? This is great. That's why we're here.
Yeah, I have a question. We haven't talked about reverse mortgages at all.
Yeah, I was just gonna
Yes.
ask about that myself.
I actually, I don't think we have any slides on reverse mortgages, but
Oh, make something
that
up.
doesn't mean
Make something up.
about reverse mortgages.
Yeah,
Well,
something
what
good.
I could, well, I want to see if I can find something, but what I could do next week, if you guys come, I could make sure to have something good on reverse mortgages. But generally, I would say reverse mortgages sometimes are riskier, but I'll see if I can get something together for next week, because I don't want to speak out of school on reverse mortgages.
Okay, thank you.
But I will provide something. So let me put a note for that. Anything else?
And if it doesn't come up next week or you can't make it, Abby, if you have a document or something, I can always send it out to through email if you find something on it that's worth sharing.
Yeah, I think I'll find something. I'm trying to see if I think the thing is the FDIC didn't have anything on it, so I'll just find something from somewhere else. But I want to make sure that it's good, because sometimes you find that there is literature, but if it's from like a mortgage lender, then it may be a little biased because they
Right.
want you to do. Yeah.
Yeah.
So.
And I know timeshares were a thing of the past. Years ago, they were hooting and hollering about the investment in timeshares. Now they're offering to sell them for pennies on the dollar.
Yeah. So, I mean, I could also include, if you wanted, even just informational about what a timeshare is and in benefits or not. In general, timeshares usually aren't a great investment, but there are some scenarios in which they can work. So if you guys are interested, I'm happy to provide that as well.
It was just a curiosity thing, that's all.
Yeah, no, I can
Sometimes
just
like in
find
a
like
big
a
city,
flyer
it's
too. It's not a big
worthwhile.
deal.
But
Yeah, I mean, well, I can talk about one scenario that I do know. Sometimes with timeshares, if you get deeded the actual land or space, as opposed to just the timeshare, where an example would be like a company like Marriott, they might give you the timeshare, but then they convert it into points. Whereas if you get deeded land or space, obviously the deeded land is more valuable than the points, because with a company like Marriott, the points have like a very fixed value, whereas the land in general won't end up devaluing. So that type of timeshare could be a good investment. So that's just like one scenario that I do know that it can work. But then sometimes the companies make them harder to, trade in, all those things. So they can be tricky.
Thank you.
You're welcome. Any other questions? I think, is this the last slide? I think so. Well, we're right at time anyway, but thanks for all your questions, everyone. And I have a note. So as I said, next week we're going to talk about retirement investing, but I'm also just going to make sure that I send Janet some information, just a little bit about reverse mortgages and timeshares. And again, just informational to help you guys have some background. And if you do have questions and you come next week, we can talk about that as well. So really appreciate you all taking the time to come and listening, and let us know if you have any other questions.